Now we turn to my favorite topic in wealth management, which is asset strategy. What I want to discuss here is how one determines their strategy for their investment portfolio. Remember, we are assuming we are investing for our retirement. Before we discuss an investment strategy, we need to see the investment portfolio in a greater context. I like to do this with what is called the personal balance sheet. In business, a balance sheet shows all of the assets the firm owns versus its liabilities. The net of assets minus liabilities is the firm's net worth or book value. For individuals, we can also create a balance sheet of assets and liabilities, but there is one asset and one liability that are very unique to individual wealth management and are absolutely critical to the development of an investment portfolio. In this chart, I show two stacked bars with assets on the left and liabilities on the right. This chart represents, on the left, a typical 25-year-old. Their assets include cash, a car, a house, their investment portfolio, and that unique asset known as human capital. Human capital is the take-home pay of the individual over the rest of their life in today's dollars. That is, the value of their human capital. Another way of saying something that is expressed in today's dollars is to say that it is the present value. So human capital represents the present value of someone's net take-home pay over the remaining life. Their liabilities include credit card debt, an auto loan, a mortgage on their house, and the unique liability, which is the present value of the amount of money they will spend during their retirement. For a 25-year-old, human capital is their largest asset and dwarfs all of their other assets. And the present value of their retirement expenditures is their largest liability, though maybe not a whole lot larger than the mortgage on their house. It depends. For a 60-year-old, their largest asset is the investment portfolio they have been building during their working years. Assuming they will retire at 65, their human capital is much smaller because while they are at the peak of their earnings years and making much more than the 25-year-old, they have only 5 more years to work, so much less human capital remaining. The present value of the retirement expenditures dwarfs all of the other liabilities because they are very near retirement and have paid off most of their house mortgage. This personal balance sheet gives us a great visual on what we are trying to accomplish in building our investment portfolio. When we view the investment portfolio as an asset next to human capital and backing a liability of the present value of our expected future expenditures, we start asking what factors impact each of these items. What impacts human capital? The most critical are the education and skills we acquire during and before our working years. It is also greatly influenced by the profession we select. Some professions are very sensitive to the overall economy, and that when the economy is in recession, people in that profession are going to be struggling, maybe facing layoffs or salary reductions during the economic slowdown. Any job that is directly involved in manufacturing or the financial services industry could fall into this cyclical profession category. Other jobs are much more immune to the overall economy as they see little impact from economic slowdowns. Jobs in healthcare or education are rarely significantly impacted by recessions. This sensitivity of one's profession is very important when designing an investment portfolio. For most people, human capital as an asset looks a lot like a low-risk, stable investment, like a high-quality bond. We will discuss bonds versus stocks in the next video. The more one's profession is immune to economic cycles, the lower risk human capital is as an asset, and the more it looks like an investment in a high-quality bond. The more one's profession is sensitive to economic cycles, the more human capital looks like a high-risk stock. For a young person whose largest asset is human capital, since human capital looks most like a high-quality bond, for most people, this means young people can place a large portion of their portfolio in a higher risk investment like stocks. To the extent one's profession is more sensitive to economic cycles, they will need to view their human capital as a mix between high-quality bonds and higher-risk investments like stocks. Though even for them, human capital will still look predominantly more like a high-quality bond than like a stock investment. For the 60-year-old, they have much less human capital and thus need to move more of their portfolio to high-quality bonds away from stocks as they near retirement, and much more so as they enter retirement. This is why young investors will have investment portfolios heavily skewed towards stocks, while older investors will be more invested in bonds. Next, let's discuss the liability, the present value of expected expenditures during retirement. What drives this liability? First is longevity, how long we expect to live. This can be a huge risk as there are many people who outlive their investment portfolios. It might sound like a great thing to live to be 100, but those last few years can get expensive with medical and assisted living costs, and those costs will appear just as the investment portfolio is dwindling down to zero. Interest rates are the more complicated to discuss for those who are not in finance. But when interest rates fall, the retirement liability increases, and when interest rates rise, the retirement liability falls. However, inflation impacts the retirement liability in the exact opposite way. When inflation rises, future expenditures in retirement will be higher, and thus this increases the present value of retirement. This means when inflation rises, our retirement liability rises, but an increase in inflation usually also means an increase in interest rates. So it can be a wash, assuming interest rates and inflation rise exactly together. This is a complex concept, but is very material to how the retirement liability will behave in different economic environments. The worst scenario would be a jump in inflation without a similar increase in interest rates. This would mean the liability goes up because higher inflation means higher expected expenditures during retirement, but then the present value of that will be very high because interest rates are still low. This usually happens when bond markets believe the inflation increase will be temporary. The best scenario would be an increase in interest rates when inflation is not rising. This usually happens when bond markets believe the economy is about to take off and inflation will rise in the future. Bottom line, interest rates and inflation levels tend to be highly related and have exact opposite impacts on the retirement liability. As such, many financial planners ignore inflation and do their planning in what is known as real terms. That is, doing everything net of inflation, assuming interest rate and inflation changes will offset each other. That is a fine approach if you are willing to take on the volatility during those periods when the two get out of step with each other. The challenge for investors is that while interest rates and inflation changes tend to be offsetting for the retirement liability, they are rarely offsetting for the investment portfolio. Rising inflation and rising interest rates are almost always devastating to investment portfolios. So while in a year like 2022, when inflation and interest rates are both rising, retirement liabilities were fairly stable, but investment portfolios were falling. Both stocks and bonds fell over 20% in 2022. As you can see, one cannot establish a strategy for an investment portfolio without considering what factors drive the asset human capital and the retirement liability. This brings us to the topics for the next 3 videos. The first video will cover what we call asset classes. That is, those broad categories of investments from which we can select. That includes investments like stocks and bonds, but we will refine it into categories to help us better manage investment risk. The third video on investment portfolio strategy will go over a model in Excel one can use to do what most wealth managers do today to determine investment portfolio strategy. Finally, I will do one last video giving some caveats that I believe most wealth managers either are unaware of, or if they are aware of them, they choose to ignore them as they make selling products much more difficult.